Good morning from London. I'm Anna Edwards alongside Guy Johnson. We're an hour away from the opening trade. Here's what you need to know. China's stocks soar for a second day as Beijing ramps up stimulus with a record cut to a key interest rate. Futures are lower on both sides of the Atlantic, despite traders ramping up bets of more central bank easing. Europe's largest software company, SAP, is under investigation for potentially overcharging the US government. We'll check in with the share price at the open. And Bettina Orlopp takes the top job at Commerzbank as it fights off a possible takeover by UniCredit. She's the first woman to lead the lender in its history.
Let's talk about the markets. As Anna says, we are looking at futures being soft on either side of the Atlantic. European futures down by circa 0.5% this morning. We're rolling over a little bit over in the United States. Yesterday was a strong session. Yesterday, US equity markets hit yet another fresh record high. One of the main reasons for that, Nvidia. Very strong pop for that stock. Feels like we haven't spoken about it for a while. It was up 4%. As Anna also says, in China, equity markets continue to gain. The CSI 300 up by another 1.6% today, and gold continues to charge higher. Yesterday was a big move. We saw a big move as well for silver. Today, it feels like we're stabilizing a little bit. We have plenty to talk about this morning. The countdown to the opening trade starts right now. Wednesday the 25th, good morning everybody, welcome to the programme. Last few days felt like they've been dominated by the macro news. We've had the story out of China, we've been watching the PMI data come out of Europe, we've seen the market impact from all of that. Today feels like, at least from a European perspective, like a single stock story, and it feels more like a German story actually. A number of single stocks that we need to be focusing on. SAP is top of the agenda this morning, but we've also got what is happening with the Commerzbank story. We need to develop that, plus also keep in mind what's happening at Volkswagen today. That is a huge story. But SAP is the most highly capped stock in Germany. Feels like the place we should start. Looks like it's going to have a tough morning. Yeah, absolutely. So we are seeing suggestions that it could be down at the start of trade. It is facing a DOJ investigation, as Tom was telling us at the end of the last hour, around whether it has overcharged government agencies over in the United States, for example, the US military. Now, it is interesting that we are seeing this share price cool down because this concerns around $2 billion worth of SAP technology. And for a business the size of SAP, with the market cap the size of SAP, you know, this is 5 times the size of VW, the market cap here, 12 times the size of Commerzbank. My first question, as I was reading this story, was how material is this going to be? You know, they faced problems with the DOJ back in January. This was around foreign bribery, an investigation there. They resolved that. The stock's still up 48%. So it's not to say that you draw a straight line between legal trouble and a stock falling. But today we are seeing some pressure on the stock, it would seem. Absolutely. The stock's had a great run. It's been a fantastic performer for most people's portfolios if they've had it within it. Is this a bandwidth issue? Is this just one of those sort of things that hangs over the company? Is it one of those things that distracts management from delivering what it's doing right now? Does it call into question, given the politics that we're seeing in the United States, its relationship with the US government? So I think there are a few headaches that come out of this. I appreciate the scale is relatively small, but investigations like this just take time and they just cast a shadow over a stock's performance. And reputational damage, you never know where that can go. So we'll see how SAP responds, what the commentary is that we get out here. There's so much German news out this morning. Commerzbank. Let's do that. So I think Orlopp's got a problem here. So Bettina Orlopp is being named to replace Knopf as the new CEO. She's been waiting for a long time to do this. She's been biding her time. Now she gets the job at a really difficult time. If she wins, she loses. And this is the challenge that she now faces. Look at the share price. Take a look at what is happening with the share price of Commerzbank. It has risen dramatically as a result of Orcel's interest. Now, Orcel is going to be speaking at a Bank of America event in London this morning. We're anticipating headlines in around an hour's time, so we'll see what he has to say. But if she wins, i.e. she fends off Orcel, what happens to the share price? Yes. Does it go up or down? My suspicion is probably it goes down. And it's really interesting to see who is really in the driving seat of what happens here because, right, she's the CEO. She's been the public face of Commerzbank for quite a time. We know that. She's come on the programme many times and spoken to us about how the business is doing. She said in the past they're on an excellent path. They don't need any kind of takeover. So that's been the sort of backstory that we've got from her. But interesting, we heard from Lindner, from the German government, of course, just yesterday, saying they didn't really like the style of what Orcel Orcel was doing. That's why they've paused the sale of the government stake here. But he did go on to say they will sell down that 12% stake, and he says the decision is up to the management and the supervisory board. Now, of course, Bettina Orlopp plays a part in that. There'll be unions expressing their views and a whole host of other German voices in the mix here.
Talking of rejecting offers, RightMove rejects RIA's latest and third offer for the company. This is the Murdoch-backed business out of Australia. RightMove rejecting another offer from that company. We'll see exactly how long it is able to resist as well. That stock is up by nearly 20%. If it continues to resist, again, what happens to the share price here? The expectation is probably it will go back to where it was on an undisturbed basis. Yes,
and you wonder if rate cuts and expectations around rate cuts have been something that has prompted interest in a property company like RightMove or a property sales company like RightMove. And let's go on to talk about what we see in the rates market, shall we? Because we've got a number of guests who'll be really interested in the way this rates conversation is developing, Guy. We've seen increasing bets on cuts in the market then, just in the last 24 hours. We're now looking at 75 basis points being priced in for the next two meetings in terms of cuts. But it's a bit of a coin toss as to whether we get 25 or 50 in November. So we don't exactly have clarity here. But there do seem to be voices, and Goolsbee is one of them, talking about, you know, we need to cut rates significantly still from here. Put Bowman to one side. We know she didn't want to go 50 this time around. She's been sounding a little more hawkish, talking about a measured pace. But elsewhere, some of the Fed voices leaving the door open to something bigger once again from the Fed.
What happens if inflation re-accelerates? What happens if the data at the end of this week signals that that is happening? What happens if we start to see the consumer getting back into gear? Now, the consumer took a big knock, it looks like, judging by the latest data in terms of confidence. What happens if rate cuts, the housing market, all start to turn around? Does the Fed decide that actually this aggressive rate-cutting policy is the wrong way to go? We still don't have an answer as to whether or not inflation is fully beaten.
Yes, and it was clear to see the links between China and Europe yesterday. But they do exist into the US as well, though, in terms of commodity prices. And if we see China coming back, if some of this policy that we've seen announced this week has a material impact, and that's still TBC, but if it does, if we see commodity prices higher on the back of that, then how does that flow into the inflation story over in the United States? That's going to be something to watch. But really interesting to think. We've got a couple of guests actually sitting on the opposite sides this morning of this rate conversation. We've got a real estate voice, you know, the conversation about how they benefit from lower interest rates, of course. But private credit, that's a part of the market that a lot of investors went into when rates were moving high because they liked the protection that this sector gave them. But now rates are coming down, and so has the conversation changed there? So we'll have some contrasting conversations with guests, I suppose, around that.
Let's figure out who we've got on the show. Let's tell you what we've got coming up. Are we going to see a rate cut in October from the ECB? We're going to try and answer that question with Marie-Anne Allier. She is going to be joining us very soon. We'll also talk about what's happening in France in a little bit more detail. At 7:30 UK, Nick Knight unpacks how lower rates are impacting the commercial property market. We'll get a take on that. As Anna says, the rate-sensitive story there, very clear to discern. Northern Trust's and Witty Bahugana is going to take us through the market open. 8:30 UK, we're going to ask Hamilton Lane co-CEO Eric Hirsch why US investors want exposure to European private markets. Do they? What is happening on the private credit front? What is happening on the private equity front? Are we going to see returns? If you want more money from me as a private equity firm, do you need to start returning me some money? All of that coming up, as Anna says, as we work our way through the programme.
Transactions and deals running through the programme then, perhaps on a number of fronts. Let's also tell you about some of the data that we're watching today. We'll get a report out of the OECD. That's at 10 a.m. UK time, the economic outlook coming there. We'll get data out of the US housing market on mortgages and other items as well. We'll have a Treasury auction, 5-year Treasury auction. And then in terms of the UN agenda, interesting to watch that develop. We've, of course, have heard from the Iranians. We've heard a lot about Israel and Gaza. Those have been the talking points recently or in the last 24 hours. Today, perhaps attention turns to Volodymyr Zelensky, the Ukrainian leader who is going to be in New York, is in New York and is going to be speaking. So we'll continue to focus there. We also have a Riksbank decision, and that's coming in less than an hour and a half's time, Guy.
Are we anticipating 25? The market seems to be thinking about 25. Some are anticipating that at some point we're going to see a 50, and apparently, according to the last set of minutes, they did discuss 50 last time around. Could we see a Fed-like surprise? Was it a Fed-like surprise? Was it a Fed surprise? Could we see 50 from the Riksbank?
Could we? Well, 23 out of 23 economists surveyed by Bloomberg say no.
Yep.
But, you know, you never know. I think there was one called the SNB, didn't they, when we got that shock cut from the SNB at the start of the rate-cutting cycle. So obviously we'll get another shock today. But yeah, you're right. The expectation is we just get 25, but the debate continues as to whether they step it up to 25 to 50 another time.
The currency is helping them now, which is interesting. The krona was very weak and now seems to have strengthened significantly. I think we're at an 8-month high on the dollar, so that takes the pressure off a little bit. What else do you need to know this Wednesday morning? More than 500 people have been killed in 2 days of Israeli attacks on Hezbollah targets in Lebanon, including the head of the group's missiles and rocket forces. Iran's president told the UN General Assembly the attacks, quote, cannot go unanswered. Back to the German corporate story, and Volkswagen has started negotiations with unions, or it will do today, over possible job cuts. Tensions have been rising since the carmaker said it was considering closing a number of factories. Analysts at Jefferies think that VW is looking to cut around 15,000 jobs globally. And Caroline Ellison has been sentenced to 2 years in prison by a federal judge for her role in the FTX collapse. Ellison was previously a top executive at the firm and admitted charges of wire fraud. She also testified against founder Sam Bankman-Fried and was ordered to forfeit more than $11 billion.
Coming up on the programme, we'll head back to Liverpool to wrap up our coverage of the UK Labour conference after Keir Starmer's address to the party faithful. Plus, we'll check on the big corporate stories at the Open. Of course, we've been through a couple of them from Germany this morning. Commerzbank gets a new leader, while SAP faces a probe in the United States. The German software company's shares slumping on Tradegate this morning. Up next, we'll check on the markets more broadly with bets of another Fed jumbo cut boosted. We'll get into that markets conversation. Do join in the conversation. IB plus BBTV Go is the function to use on the Bloomberg terminal if you want to get in touch with us, with the team that puts together this programme. This is Bloomberg.
45 minutes to the opening trade in Europe this Wednesday morning. It looks like we're going to soften up a little bit. Certainly that's what the futures are signalling. Let's talk about what's been going on in New York. The IMF Managing Director, Kristalina Georgieva, says the US is in a good place when it comes to inflation, but is warning that slow growth and high debts are a cause for concern. She spoke to Bloomberg in New York.
Two very important points for your audience. Number one, yes, growth is holding, but by historic standards, it is not high enough to retain good prospects for our economies. Before the pandemic, average growth, 3.8%. Two, we also have very high debt levels. And that combination of slow growth and high debt is something that we at the fund worry about. What we want to see is countries taking seriously the importance of fiscal prudence. So the central banks have done their job. They fought inflation. Inflation is going down. Rates are going down. We need the fiscal side to be equally committed. And of course, we want to see more attention as to what drives growth up.
I want to go back to inflation, though. With the Fed finally making that big move last week, that half-a-point cut, inflation defeated, mission accomplished, done? Or would you say not necessarily yet?
Well, watch it. Yes, we are in a very good place. We have been predicting soft landing. We would see inflation down and growth still remaining firmly in positive territory. This is where we are.
Right.
We know that in the services, inflation is still flaring a little bit more, so the Fed is going to watch it. But broadly, we think that the Fed got it right, and we would see how that evolves in the next meeting of the Fed. Not to exclude there could be more cuts. But again, why is the Fed successful? Because it is data-driven. So they would watch incoming data very carefully.
The Fed is successful because it's data-driven. The IMF Managing Director, Kristalina Georgieva, speaking to Bloomberg's Carol Massa in New York. Marie-Anne Allier, fixed income fund manager at Carmignac in Paris, joining us now to carry on the conversation. Good morning. The Fed is successful because it's data dependent. Let's just talk about that from an ECB point of view. The data in Europe look terrible right now. And I'm wondering whether or not, if the Fed is being successful because it's watching the data, whether or not the ECB is being unsuccessful because the data are turning against it more quickly than anticipated. Marianne, do you think there's a possibility that the ECB should be cutting more aggressively? Should we be looking at October as a realistic option for another rate cut from Frankfurt?
Well, looking at economic data, as you said, for sure they should, I don't know, but they could cut in October. Growth is very low, if not, at zero in the Eurozone. Germany is maybe will go again in a bit of recession. So just looking at inflation will be below target in September, October. So economic data, they should cut in October. But when you look at what the ECB member said, they said, yes, we are looking at the data, we are looking at wage growth, we are looking at inflation in services, and that is not at our target. So they tend to say it will be 25 per quarter, so the next one is in December. But I think it's a close call. And it will maybe depend on the Fed. If the Fed is doing another 50 basis point cut in October, the ECB could be a bit more rapid to cut.
Is the ECB fighting the Fed? It feels like we're on different trajectories at the moment.
It's not a question of fighting, but if, the Fed is cutting rate, then it has an effect on the euro-dollar, and probably the euro will be a bit stronger, so it will be difficult for growth, and especially for Germany, for Italy, for people that are exporting. So that could be, a reason to cut more rapidly, and again, it's a question of how quick they will take growth into account in their model.
Good morning to you, Marianne. You talk about typically the ECB suggesting they'll go 25 basis points a quarter. That does seem very slow versus a Fed that did 50 in 1 month. To Guy's point, can they continue to be on very different pages?
First, the ECB began before the Fed. The ECB cut in June, so they have done a 50 basis point cut like the Fed. So it's just a question that they began quicker than the Fed. And second, we are not at the same level in terms of absolute yield. The Fed was at 5.25. The ECB was only at 4. So still now we have a big difference in terms of absolute yield in the US and in the Eurozone. And third, Fed has growth and inflation in its mandate. The ECB has only inflation. So they never talk, they should not take growth into account. They have inflation, and again, in that case, they are saying inflation in services is still a bit too high.
Can I talk to you, Marianne, about the budget story and the debt story over in France? We see comments from Villeroy, the Bank of France governor, speaking this morning, saying that France must deal with its debt problem as the spread widens. How much is spread widening being talked about in Paris? I mean, maybe it happened some months ago, but these wider spreads have persisted.
Yeah, it's not for the moment. As of today, it's not a big problem. At 70 basis points, you can't say, looking at the French budget trajectory and the deficit of France, you can't say that it is something totally abnormal to have a spread at 70 over Germany or 70 or maybe 80 today. So at the moment, it's not a big deal. And even more than, the insurance company, they are not overloaded on France debt. So for the moment, it's something that is still manageable. It's not something that we are looking too closely. For sure, we know that if this spread is widened suddenly and by large, it will begin something that we will look at. For the moment, it's not a story we are debating a lot in France. people are not believing that it could happen, you know, to have 200 basis points or something like an Italy-style spread.
What happens if we can't see a budget going through in December? What happens if this government fails? What happens if we start to see the politics unravelling and we really struggle because we can't have another election? How does the bond market deal with that?
I'm not sure it can. And it's probably what will push, you know, the budget to be voted in a sense or another one. The market will be probably, you know, the place where they will put pressure on politicals to find an agreement. For your question, there is a lot of unknown. It's a situation that have never happened. Let's say in France, if we have, you know, no majority for the budget, no possibility to have a snap election, there is still discussion between, you know, professors about what can or can't be done for the next budget in 2025. But for sure, if the market began to be very worried about, they will find a solution.
Marianne, we talked about the spread of France over Germany. The team were talking here about the spread between, which is very small, between Spain and France recently. What opportunities are you looking at? Because we see quite a lot of volatility recently. What opportunities are you looking at in European fixed income?
Well, we still like a lot, you know, the credit market, the investment grade credit market and a bit of the high yield credit market. We are not looking, you know, for a recession in the US. So we think that corporate are still, the debt problem is a government problem. It's not so much a corporate problem. So we still think that there is savings in Europe. These savings are invested a lot in fixed income, and we have seen a lot of inflows in targeted credit fund. So we know that this part of the market is quite protected, and we think that you still have some you know, opportunities in the credit market in the euro fixed income. You were talking about Spain. I don't know if Spain will be below France or above or at the same level of France, but for sure the Spanish economy is doing very, very well, and I think they are rising their growth target this morning or yesterday. So we can see, you know, spreads below France in the next months or next quarter, for sure.
In terms of what is the right trade from a sort of yield curve point of view, Marianne, what is the right trade right now? Everybody seems to believe that the steepener is the way to go at the moment, that we are going to be seeing front-end yields coming down, that the back end is going to be more stable. Is that the right trade?
You have still, in the forward curve, steepening is already well priced. Yes, it's probably a cautious trade in the sense that if growth is not going well, you will have, you know, a rate cut from ECB and central banks, and at the same time, we will probably see, you know, more deficit, because if Germany is going very badly in terms of economy, they could raise their spending, so they could expense their debt program, and in that case, you know, long-term yields could be a bit under pressure. So steepening seems something that is quite cautious in the term that you are betting that central banks are not totally stupid, and at the same time that fiscal loosening will continue a bit and it will put pressure on the long term. So yes, we still like steepener. We like inflation
not totally
bonds
stupid
as well for the...
Yeah. Like inflation-linked bonds as well for the risk mitigation. Marianne Allier, fixed income fund manager at Carmignac, thank you very much indeed. Up next, we're going to talk about what is happening in the UK. Keir Starmer's big speech yesterday. We'll analyse that. This is Bloomberg.
That if we take tough, long-term decisions now, if we stick to the driving purpose behind everything we do, higher economic growth, so living standards rise in every community, our NHS facing the future, waiting lists at your hospital now, safer streets in your community, stronger borders, more opportunities for your children, clean British energy powering your home, then that light at the end of this tunnel, that Britain that belongs to you, we get there much more quickly.
That was the UK's Prime Minister, of course, Keir Starmer, speaking at the final day of the Labour Party conference in Liverpool. So how did the leader's speech go down? It's the first by a Labour Prime Minister in 15 years. Bloomberg UK correspondent Lizzie Burden is in Liverpool still for us. Lizzie, good morning. So we heard, positive reaction to the speech in the room. Often you see positive reaction in the room to these things. What wider reaction have you been picking up?
Exactly, raucous in the room, but who cares about that? It's what's outside the room that really matters, Anna. This was his first speech to party conference as Prime Minister. Lots of lofty rhetoric, as you heard there. This repeated reference to the Labour way, so saying that he's going to be honest with the public, he's going to be realistic, a contrast to the boosterism of Boris Johnson. But that doom and gloom narrative is already weighing on consumer confidence. We saw it in the GfK numbers on Friday. It's weighing on the polls as well. Ipsos saying that 6 out of 10 Britons aren't happy with the government. And yet, Keir Starmer deciding to stick with this message of tough long-term decisions for a decade of national renewal.
Lizzie, is that a consistent message? Is the Cabinet on the same page when it comes to this message? Is everybody singing from the same hymn sheet?
Well, specifically for our audience, they're interested in the fiscal decisions, and the message repeated by all of the Cabinet Ministers I've spoken to is that they need to plug this £22 billion hole in the public finances. The worry for our audience is that that spells tax hikes, and I asked the Business Secretary, Jonathan Reynolds, whether he expects an exodus of wealth in reaction to that. Here's what he said.
I think that's too dramatic. Look at what I said, look at what Rachel Reeves said yesterday about that total commitment to improving the business environment in the UK. But look at the big picture too. I mean, the political stability of the UK within the G7 has been transformed by the election result. You have a government committed to active policies to improve the business environment, even where it's politically difficult, like planning and building homes, and of course fundamentally an open internationalist outlook.
So no exodus of wealth creators. But look, that's not what businesses are telling us. We've heard from the private equity firm General Atlantic saying that some of their staff could leave the London office. We've spoken to Alan Howard, the UK hedge fund billionaire. People around him say he's thinking about moving to Geneva. And already the pioneer of UK private equity, Jeremy Collar, has upped sticks for Switzerland. And they're not the only ones, Guy. You've got a survey by S&P Global finding that businesses are holding back on their investment decisions while they wait for detail in this budget on October the 30th. But we've not had much detail at all here in Liverpool. We've not had an investment minister announced, for example. Still several weeks to go until October the 30th.
Thanks very much, Lizzie. Bloomberg UK correspondent Lizzie Burden with the latest from Liverpool. Yeah, we'll see how the private equity industry continues to respond.
Are we going to need any offices? It sounds like everybody's leaving.
I think that's yes. Well, maybe a slight overstatement for dramatic purpose. I say it with a smile on my face. Absolutely, this isn't radio. Let's talk about where we go with the office space, shall we? Buyers and sellers in the US commercial real estate market are increasingly convinced that the troubled market is reaching a bottom. But the big question remains, at what price will beaten down offices actually change hands? Let's talk globally about commercial real estate. Nick Knight joins us, Managing Director for CBRE UK, but casting his eye across the world for us this morning. Nick, very good to see you. We'll come perhaps to the UK story in just a moment. But if I start with what's going on in the US commercial real estate, our reporting suggesting that buyers and sellers, they're all being more positive, rates are coming down in the States, talking about the market taking off again a little bit, or at least some transactions actually happening and getting a firm sense of pricing. Is that what you're seeing?
Yeah, good morning, Anna. Thanks for having me. I mean, absolutely that. We can't underestimate the impact of the interest rate cuts that we've seen and the fact that inflation is now coming under control, and the expectation is for further cuts as we go into 2025. Effectively, what that means is we're starting to see that spread between the risk-free rate and property yields widen again, which in itself is a buy signal. Obviously, corresponding costs of debt and leverage is really important in real estate transactions. That coming down is also of benefit. So we've had a very quiet couple of years. The last 2 years, transactional volumes in the US and globally have been off somewhere between 35 and 40%. So we've been in a liquidity-constrained environment, which means there hasn't been much price discovery, but we have seen values correct. So not only is the rate environment much more favourable, but actually entry prices are that much lower.
Yes, absolutely. I mean, we've seen some of our reporting, talking about one building in New York City, 67% less than its 2018 purchase price is what it sold for. The former Chicago headquarters of CBRE sold this summer for about half its pre-pandemic value. I mean, is there any set? Do you have any kind of benchmark? I guess it all comes down to the age and the state of the properties involved, doesn't it? But
yeah.
What benchmarks are you looking at?
I think one has to be very careful with the offices and generalising. The office market is very stratified. Obviously, with the pandemic, we've had changes in the way people work. We've had changes in what occupiers want from office space. And what you've found is that there is a big gap between the best space and the more obsolete space that requires some repositioning. So we've seen very different net absorption rates in American cities and in London and in European cities for that top-level prime space, where the corporates recognise that it's a real draw for talent back to the office, important for culture, but that less high-quality space with the lowest floor-to-ceiling heights, the less natural light, that needs some work.
And that's what people want, is it? Ceiling height.
Ceiling height, space, collaboration space.
Guy's very pleased.
Offices like this.
It's quite tall.
Well, precisely. Being tall, it certainly helps. The FT's reporting this morning, it talks about the can of ham skyscraper in the City of London being put back on the market by Nuveen. 322 million, we understand, is the price tag for that. Probably more officially known as 70 St Mary's Axe. You've got City Point on the market as well right now. Some of the prime stuff is coming back on. People have hidden out in the prime stuff. Nuveen has been in, obviously, they developed that space. Are people going to start selling the super high-end stuff with the high ceilings in order to take advantage of the opportunities that are elsewhere in the market? Are we going to finally see people basically coming out from underneath the prime rock and looking at other opportunities?
So I think there are different pools of capital looking at different opportunities, within the real estate market. What I would say about the city in particular is you only have to walk around the streets of the city to realise people are back, to realise that there's a lot of activity. We think that's going to translate into positive rental movements going forward. So whilst we have seen an absence of these larger ticket transactions because of our interest rate environment, because of constrained liquidity, we do think where pricing has got to, it is now flashing as a significant buy opportunity.
They tried to put it on the market back in 22 for 400 million, so there's a significant discount that's being applied even to the prime stuff.
Absolutely right. And if you look at our own UK index, which tracks valuations on a monthly basis, we are showing, on average, offices off from the peak in June 22 off about between 28 and 35%. So again, with capital coming back, they're coming back at different pricing.
What yields am I getting at the moment? What is the kind of average yield across London?
Yeah, so in the city, there is a difference between your large tickets and smaller lot sizes. So we would say that around the 50 million mark, 5.25% would be the right sort of yield. If you're up in the higher end, that's probably 25 to 50 basis points wider at the moment. It is, as is been traditionally the case, the yields are lower in the West End. So you're in the 4 to 4.5, 4 3/4, depending on lot size there.
Nick, you mentioned people are back in the city, and there are certainly days that feel pretty busy, but there are other days that feel a little quieter. And I can look across the news landscape and look at businesses saying, come back to the office 5 days a week or 4 days a week or whatever it is, and that maybe is a direction of travel. But then I'll talk to another business and they'll say, oh, we just downsized our footprint because we just didn't need as much space as we do. So what is the post-pandemic sort of structural shift that we can see to date in terms of the required space that companies need?
Look, I think it's been an amazing topic of conversation for the last 2 years, post-pandemic, and I think it's still settling. What we're seeing is corporate occupiers looking very carefully at their portfolios, at what their talent wants. Remember, in office space, you do have to cater for the peak of the week. So, you want, whilst Fridays and Mondays can be a bit quieter, we're seeing those occupancy rates rise, but you do have to cater for the peak of the week. I think undoubtedly what we've seen is, as I said earlier, the way that people use the space is changing. So we hear a lot about space for collaboration, people wanting to bring their people together in a very interactive environment, which is lost when people are slightly more dispersed. So I think this has got some way to play yet. But interestingly, going back to the cycle point, we haven't seen a spike in unemployment. So, you know, there is still demand for space. And as the economy grows, we know that rents and absorption is really quite closely linked over time to GDP performance. So, again, although it's, you know, we've got a resilient economy, we've got, you know, we think that will play through into rental growth too.
Money's being raised, but how, like, we're at the bottom now. Let's say we're at the bottom now. How long does the recovery take? How long before we see proper crystallisation of values, before we see the bottom of the cycle turning into a significant upswing in the cycle?
Yeah. So I think we're calling this is the build-up phase at the moment. We think, you know, most sectors in most markets are at or just beyond the trough.
Right.
But we think that transactional activity will grow gradually. We don't think it'll come roaring back at the moment. So we're saying within the US market, we think transactional volumes will grow 5 to 10% in 2025. In the UK, we're 10% higher than we were this time last year, and we see that sort of trend continuing. So I don't think you're going to see a very steep rebound, but we're in a build-up gradual phase.
So I was going to ask, where's in the lead on this? You know, who's ahead in this trajectory? Is the US coming out of this more quickly, or parts of Europe? I mean, rate cuts came sooner here, but they were foreseen everywhere.
Yeah, I think the different pace of rate cuts that was part of the previous discussion you've had is interesting, and that will affect capital allocators. But I think, in general terms, where you know that there is some homogeneity amongst the picture. We have got, you know, real estate is an asset class that requires leverage, interest rate. It is very linked to interest rates, and we're seeing them coming down. And yields, you know, there is some relative difference between yields between markets around the world, but I think we're seeing the direction of travel pretty uniform. I think within the real estate markets, though, we obviously have sector differences. And, you know, there's been a lot of noise about offices, but we've also had sectors that have been very, very favourable, you know, post-pandemic, industrial and logistics in particular. There's a lot of capital chasing the living sector as well. Life sciences, again, quite high up on people's radars at the moment. So I think, you know, there are lots of individual strategies within that general real estate picture.
Great to see you, Nick. Thanks for stopping by to see us. We really appreciate it.
Thank you very much, guys.
Managing Director at CBRE UK. I've never realised that there's a kind of food theme that basically runs through the London skyline. So you've got the gherkin.
Yes. The can of ham.
Can of ham.
Making a lunch here.
Well, I'm just thinking, the cheese grater.
Yeah.
So there's definitely a food theme. The walkie-talkie kind of, we'll park that to one side.
But sounding like a ploughman's, which is a reference that nobody outside the UK will have any clue what I'm talking about. But
sounds quite nice,
anyway,
doesn't it?
Let's go get one.
A long lunch with a ploughman's. Coming up, a US investigation into SAP could spell trouble for the German software developer. This is Germany's most highly capped stock. We need to talk about it. We'll do that next. This is Bloomberg. Good morning, good Wednesday morning. 12 minutes to go until the start of trading here in Europe, and the omens don't look particularly good. Futures pointing us towards maybe a negative start. We saw a solid session yesterday. Tech did well in the States, Nvidia did well. We saw the China effect coming through into Europe. That looks like it's fading a little bit, despite the fact that Chinese markets actually have had a fairly good session again today. Mark Cudmore is bullish about global stocks. Take a look at his latest piece on the Bloomberg. He is certainly arguing the bull case, saying that as investors become more optimistic on the economy, yields will rise and stocks will climb to fresh records. Our Markets Live executive editor joins us now. Mark, is it US markets or is it global markets?
It is much more global markets, but of course, in this world where US markets are so important, you can't really be bullish global markets if you are not at least slightly bullish US markets. I just don't think that's where the juice is. I think where US stocks are not only some of the most expensive valuations, but they are the ones that have priced in the full benefit of a potentially aggressive Fed policy, while also still being optimistic on the economy. Now, my base case is that we'll actually see yields rise because global growth and even US growth is doing absolutely fine and recession will not come. And so yields will back up. I think stocks in the US will do fine through that, but they won't necessarily do brilliantly. They'll bounce around a bit. But that backdrop of good growth holding up okay, I think we'll continue to see fresh records around global stocks. And of course, it is helped by that whole dynamic, that fresh dynamic of what's happening out of China. As you know, I've been a bull all year even before that dynamic's come in, but that definitely helps the margin, even if the short-term price action today was actually quite disappointing on the session.
You only have to look at what markets do, futures in equities, Mark, do on a day where expectations rise that we get a 50 basis point cut from the Fed to see that markets are still primed to move around Fed rate cut expectations. And if the global economy does as well, or the US economy does okay, as you suggest, we maybe don't get so many rate cuts. But you think stocks can still go higher in that environment?
Yeah, but we've got to remember that what's happening at the moment is that we're pricing in that we're going to have a really, really severe slowdown. And that's what's really, the problem with stocks. Now, obviously, the short-term moves in yield, it's supportive to know that, hey, the Fed's going to react to that. They're not going to go into this slowdown and keep rates really, really tight. But I think if we get a narrative that, hey, the economy is not folding, and I think that's a very important assumption and probably where my base case needs to be most closely challenged. If the economy holds up, in that environment where rates move higher because the economy is not struggling, the economy does not need easier policy, that is a supportive environment for stocks. And that's the point I'm making, that if there are the conditions which see yields rise, those are the same economic conditions which will reignite the stock rally yet again.
Let me ask you the same question I asked you yesterday, which is about the Chinese consumer. We feel like we've got a PBOC sugar high coming through. How long does it last?
Well, the price action today was pretty terrible. Hong Kong stocks opened so much higher and, ending towards the lows is when I walked into the studio. So I'd say that the very short-term price action is people are still not convinced by this. Obviously, on a two-day basis, they're still up a lot, and the gains we've seen in the region are generally very high. I think this is going to last. I think the people who are disappointed are the people who are looking for China to return to the bull story of the mid-2000s. That's not happening. But we're no longer going to have the negative story. We're going to have a holiday next week. Consumers are going to talk with their friends and family and get more enthusiastic on the economy.
Thanks very much, Mark. Bloomberg Markets Live Executive Editor Mark Cudmore. Thank you very much for joining us. Remember, you can get up-to-date analysis and insight from Mark and the rest of the team. MLIV Go is the function to use on the Bloomberg terminal. Let us get an update on individual stocks in focus. Joe Easton from our equities team has a briefing, and we have to start with where we started this hour, Joe, with SAP.
Morning, Anna. Absolutely. So we are looking at SAP on news that they're facing a probe in the US over potential price fixing. This is on the supply of software to the military and also other US government departments. Now, when contacted by Bloomberg, SAP did decline to comment on this news. But there is potentially significant downside in this stock, given we can see over 2 years it's up around 150% and is also one of the favourite stocks in Germany with 21 buy ratings. So potentially there is a bit of downside ahead for that one. We are seeing some declines on the Tradegate exchange early this morning as well, so do keep an eye on that one when we get the full trading opening up. Then we're staying in Germany to once again look at Commerzbank. Now we've got a new CEO coming in at the German lender, Bettina Orlopp. Now she's kind of been waiting in the wings for the past few years. Not really a surprise choice for the replacement. Remember, we got news just a couple of weeks ago that the current CEO was standing down. That came just before we got news of UniCredit buying this big stake. As we can see from the screen, UniCredit now the biggest shareholder in Commerzbank. Now, importantly, reports suggest that she does oppose any kind of big cooperation, big tie-up or merger with Commerzbank, and that's what analysts are going to be focusing on, where that M&A story goes from here. The stock having a decent run, of course, over the past month, given that M&A news, up around 16%, but we'll keep an eye on how the market reacts to the change in leadership at the company. Then switching over to airlines, we got a note out from JP Morgan today becoming more positive on the European airline space. They say that passenger numbers remain really strong, and more importantly, fuel costs are coming down, and that should benefit the entire sector. Probably the stock we want to watch the most, though, is Air France. Double upgraded, so they go from underweight to overweight, and they give it a decent price target as well. €12 they say it's worth. It currently trades about 8, so almost 50% upside on top of the rating upgrade. I would also note that there are now 8 buys, so positive in terms of the makeup there. The other stock to watch is EasyJet, because JP Morgan calls that their top pick in the sector, so we would expect both of those to see positive trading today. Keep an eye on airlines following that JP Morgan note.
Thank you. Thanks, Joe. Our equities reporter, Joe Easton, with an update on stocks in focus. And, Guy, we're keeping an eye, Joe was mentioning Commerzbank, we're keeping an eye on a conference, a banking conference that's taking place at the top of the next hour. We might hear from Andrea Orcel.
We think he's probably going to be asked some questions about where he stands with Commerzbank, what the latest is, what kind of pushback he's getting, what are the conversations looking like with the German government, if any at all. I'm quite intrigued to see what he has to say, given we've now got new management coming in at Commerzbank.
Absolutely. We'd be disappointed if he were not asked about those things. Let's just say that. We see commodity prices moving higher this morning. That helped basic resources move higher on the back of that China story yesterday. Futures here in Europe, though, look a little lacklustre. We'll be back with the market open. This is Bloomberg.
Wednesday morning, good morning. Couple of minutes to go until the start of equity trading here in Europe. Let's talk about the legacy from yesterday and what it means for the start of trading this Wednesday morning here in Europe. Europe did pick up a little bit into the close yesterday. That was as we started to see a rally in the United States forming that took us into the close. Now, a lot of that was driven by expectations that we are going to see potentially bigger Fed rate cuts coming through. The consumer data yesterday maybe spurring that action. In some ways, you can argue that a weak consumer in the States, not necessarily what stocks should like, but they did kind of yesterday. And we certainly picked up our pace into the close. One of the main stock drivers for that was Nvidia. Take a look at Nvidia, up by 4%. That was one of the really big drivers. Tech stocks, though, could be quite an interesting stock story here in Europe this morning with SAP. Keep an eye on that stock story out of Germany. Anna will talk about that in just a moment. In terms of the futures picture, this is what it looks like here in Europe. A little bit of softness. Now, remember, Chinese stocks have also been rolling off into the close. They're still positive, but are a little bit more negative than they were a few hours ago. So Eurostock futures down by 0.6%. FTSE futures down by 0.6%, 0.5%. At Nasdaq futures down by 0.5% as well. So the tide seems to have turned just a little bit. But last few days have been dominated by the macro. Today feels like a single stock story, Anna.
Yeah, absolutely. And SAP to the fore on that front. Although I was looking for it to have more of an impact to the downside on DAX futures. You don't see that the DAX futures picture stand out as being particularly more negative than CAC futures, for example. But SAP in focus, the DOJ investigation taking place there. This is Germany's most valuable company, so we certainly watch where that one trades at the open. Commerzbank in focus as it appoints Bettina Orlopp as the new CEO. We are waiting to hear from Andrea Orcel this hour, and we'll keep RightMove in focus as it rejects for a third time an offer from RIA over in Australia, Guy.
OK, it's time for the opening trade. Let's see how Europe opens this Wednesday morning. As we've been telling you, we are anticipating a negative start to the story. That's already what we see out of the gate for the FTSE 100. A little bit of a fade as the Chinese session has got on, maybe starting to impact as well what the story looks like here. US futures are quite negative. The stock 600 comes out of the gate down by 0.2%. We'll wait and see exactly how the DAX opens this morning. There's a number of single stocks you want to watch out for there. Commerzbank, what's happening with SAP. But I'll throw in Volkswagen as well. Negotiations with unions start today. Keep an eye on that story. Certainly German politicians will be. The CAC is open. It is down by 0.7%. It was one of the big gainers yesterday as a result of what we saw in terms of the luxury sector and the read across from China. The expectation that that would deliver a more positive picture. The IBEX down by 0.4%. Anna, below the surface, what are we seeing?
Yeah, below the surface, looking for clues as to how different today's session is from yesterday, and it is very different. Yesterday, of course, we saw basic resources was really leading the charge. We had the China news overnight, and that certainly lit a fire under equity markets in the short term. Today, as you rightly said, described it earlier on, Guy, a bit of a sugar rush for equities yesterday. Today looks different then. We see many more defensive names to the fore, like healthcare, for example. That is the best performing sector in the very first moments of trade here in Europe. We do see basic resources not doing too bad, not selling off hugely, but pretty flat. Chemicals also doing all right, so not entirely defensive at the top of the sector list. To the downside, we see energy names, and we have a little bit of weakness on the oil price. 74.95 is where Brent trades, and that energy sector is the worst performer, down by 0.9%. But yeah, we're still dealing with the sort of sugar high of yesterday and the aftermath of that, it would seem, and plenty of time to get into some of those individual stories as well.
Yeah, let's get in and see what the single stock story looks like. This is coming out of the Stocks 50, and as Anna says, what you're seeing is some of the mining stocks continuing to have a relatively good performance this morning. Some of the more defensive names, actually, interestingly enough, are rolling over a little bit. So names like Diageo under a little bit of pressure. Airbus is also down. Keep an eye on what's happening with Boeing. Some of the financials are a little soft. Some of the core six, look at what's happening with Schneider this morning. In terms of the Stock 600, let me give you a wider remit in terms of what we're seeing on the stock story this morning. From a point of view, Total is down fairly hard. I need to double check and see exactly what's happening there. But that stock is down by over 2%. But Shell is also down. Schneider's tracking a little bit lower. This is where the point story lies. In terms of the downside, I think there's a clear... I can't see a clear read across, a clear sector kind of narrative when I look at what is happening. Some of the UK house builders are having a much more positive picture. Let's get a take on what is happening with this market. Oh, SAP. We've got a trade on SAP? Let's see what
it's
SAP...
closed last... Oh, it's just opened, yeah.
SAP, there you go, down by 3%.
Yeah, absolutely. And so that, you might think... I mean, it's quite a heavy weight in Germany, but it's... The German DAX is down 0.75%, and so is the CAC 40. So it's not having too much of an outsized influence.
It's also had a sensational run so far this year.
It has, up by more than 40% year to date on a DAX that's up by 14 or so.
Yeah, I'm still surprised how well the DAX is doing. You could argue, given what we're seeing in terms of the economic backdrop and how that relates back into the DAX, it's an interesting little relationship. And Witty Bahugana, Global Asset Allocation CIO, Northern Trust Asset Management, joining us now. Nice to see you. Good morning.
Thank you for having me.
What do you make of these markets?
Quite interesting. You know,
you're quite positive. Your glass half full.
Definitely, we are risk on in asset allocation portfolios in Northern Trust. So we have an overweight to stocks over bonds, and we are neutral. The third big category where we invest, which is real assets, but you know, what's not to like with resilient growth globally, inflation coming down, and monetary policy loosening all over the place.
How far does it go? How far could that combination, that cocktail, a very nice cocktail, take us?
So two things could go wrong, right? Growth could weaken more than we expect, and we're not seeing signs of that, at least in the US. Or inflation stays stickier than everyone's priced in so far. So bond markets are thinking rates are coming down, inflation's coming down, Fed's going to ease, ECB's easing, BOE's probably easing at some point. So things to watch out for, guys. Does inflation indeed come down? And does growth weaken more than the soft landing story that everyone's priced?
So I was going to probe that a little bit, because it all sounds quite soft landing and Goldilocks, and that's quite difficult to fine-tune and achieve by some people's accounts. So what is the big risk? Is it that growth is more resilient and inflation is higher and we don't get rate cuts? I mean, what's the risk to the view?
The big risk to the view, in my opinion, is that when growth starts to soften, it's really hard to distinguish between, is it softening to a below-trend pace, or is it going into a recession? And the line starts going down, and it's impossible to distinguish sometimes between the two. So that means a little more increased volatility in the stock market for folks, those who think this line just continues to head down, not just below trend, but into negative territory, versus those who think that it may just soften a little bit. And that inability to distinguish between the two can cause a lot of volatility.
Can I ask you about the banking sector? And I know, Anwiti, that you're visiting from the US, but I wonder how appealing parts of the European banking landscape look to you or not right now. We're just getting some lines coming out from Andrea Orcel over at UniCredit. He's speaking at a Bank of America banking conference. We know he's in pursuit of Commerzbank, and he says they're moving into a leadership of the sector. This is UniCredit. He's saying that he's speaking very positively about Commerzbank, as you might expect, saying, and indeed his own bank, saying that UniCredit is the most efficient bank in Europe, pitching himself as a good owner, I suppose. How appealing, this consolidation story rumbles on, how appealing do banking stocks look to you?
So, look, stepping back from a macro lens, we have actually just downgraded from an overweight to market weight our European exposure. And really the worry has been that all the economic data is looking quite shaky.
Yep.
Whatever you've seen for the last at least 4 weeks has been PMIs below 50, sentiments rolling over, and your opening comment, Guy, was that DAX was up 14% or something.
Yeah.
So that was the disconnect that we were looking at. That, well, beginning of the year, we did think we would see a nice uptick, but it started to slow down way more than any of us anticipated. And inflation is coming down, but not fast enough to think that there would be a very sharp relief on the rates front, which is what banks like. So to us, it's not a it's not a place to take a lot of risk in that segment right now. And we have just gone neutral on the region. It's not bad enough for us to go underweight yet.
Okay. What would it take to go underweight?
Again, growth story.
Lack of ECB rate cuts. If the ECB accelerates the rate cut story, does that make you more positive?
Depending on why they...
Precisely, or does it make you more fearful?
So why are they accelerating the rate cuts, right? If it's because growth slowing down, that doesn't make me positive. But if it's because inflation is coming down faster, they think they're far above their neutral, good time for them to come back to neutral, that can be actually quite positive for the economy. And we are beginning to see lending surveys show some positivity, not the real data, but the lending surveys are beginning to show some positive tone to them. So not fearful enough to go underweight right now, just staying neutral.
What do you make of the Chinese stimulus package?
Oh, that's something we've been waiting for a long time.
Is it big enough? Does it do anything? Does it change your view on the markets?
So we broke it up into 3 components. The monetary component, which is really good, actually. Good for companies in China also, right? Property market component looks quite good. But if you talk to the China bears, they're going to focus on, well, there's no fiscal, it's only monetary, it's only property. To me, it's never all one at once, and it's a nice start, and something market was waiting for, and something market had not priced in at all, because if you look at the valuations for Chinese stocks, they are pretty much at the 10th decile, bottom decile. So a lot of the bad news is priced in. The government is starting to do something. We are actually overweight the emerging market equity complex, not one country in particular, but China is a quarter of that index. So, yeah, I think this could have some legs.
So it's a nice start, but it's interesting to think about what is the end point, Anwiti, because having conversation with guests over the last 24 hours, it seems as if you don't have to believe that China's going back to growing 8% a year to be positive on Chinese stocks.
Yes.
But you probably do have to be a bit more positive than you've been about the Chinese consumer to see a real turnaround in that economy.
Yes. I mean, there are measures in the policy announcement that does release some more spending capacity for the consumer. The rate cuts are going to help. Some of the rule changes on how much down payment you need on housing, where you can buy housing, those sort of supports are going to be supportive of the Chinese consumer. But I'm 100% with you that it doesn't mean an 8% growth rate. I think that everyone's very nicely forgotten and will be very happy to have 3 to 4% growth rate, which is still double what the developed world is growing at.
Yep. Right. Talking of the developed world, are you positioning for the US election yet?
No. It's impossible to call at this point.
Okay.
We talk about it in terms of 4 layers of risk.
How do you hedge it then?
You don't. You cannot. You have to wait and see what happens.
Okay, so 4 layers of risk.
4 layers of risk. So the one, we don't know who's winning. The elections
Yeah.
are too close to call, so that's one layer. The second, we don't know the makeup of the Congress, and that guy is very important because the president does not make rules unilaterally. It matters whether we get a split Congress. It matters who has control and all those. And then the third layer we think of is that whenever they're campaigning, their rhetoric is a lot more sharper than what they actually end up proposing in the rule-making phase of the governance. And that is many times lower in terms of its impact than what they start out. It's not going to be 100% tariff. Maybe it's 40%, maybe it's 60%. We don't know.
Right, and is that true for a second term for President Trump as well? That the things that are enacted are not the same as the things that were promised? And how much do you use 1.0 as a playbook for Trump 2.0? Because some people say that the impact this time around could be a lot bigger.
Yes, that's definitely a risk. But again, to that third layer, we don't know the makeup. Right? Does he have the support of the Senate and the House to do all these things? On the tariff side, they can do things unilaterally. And then the fourth layer that I do want to get back to is that we have these theories on what tariff means for inflation, what it means for growth. But in terms of economic impact, it's still not always clear because that's not the only thing affecting the economy at any point in time. There are a lot more other fundamental factors at play.
It's so difficult to get to that sort of everything else being equal.
Exactly.
Points.
Everything else is never equal.
Difficult to analyse, yes.
So what's the investment theory around the US right now? Is it that the Fed is going to cut rates, that the economy is going to be great? That's how you started the conversation, that the cocktail looks great. But, But I don't. There's an extra mix that I don't know what I'm putting into the cocktail, which is the politics.
Yes.
How do I kind of balance out those risks? Everything else looks great. Economy still looks fine. Fed's cutting rates, but how do I think about risk in the US markets? How do I think about volatility? If the known unknown is so difficult to quantify?
You focus on the fundamentals. And the earnings growth in the second quarter was around 11.5% or so. Projections for the remainder of the year is still very strong. And the best factor to me that I've focused on is that U.S. market performance is broadening out away from your Mag 7 stocks into other parts of the economy.
Okay.
So that actually is really good validation that people have stopped hiding in a few growth names and have conviction in other parts of the economy that earnings are actually broadening. The rate cuts are going to help the margins. Margins are staying elevated. And those fundamentals are all you can focus on at the moment, not knowing any of those 4 layers of uncertainty that I talked about.
4 layers of uncertainty. Thank you very much indeed. And Witty, great to see you. Thanks for stopping by. I really appreciate it. And Witty, Bahugana, Global Asset Allocation, CIO, Northern Trust Asset Management. Thank you very much indeed. Quick look at the Core 6. Let's see what's happening there. We've already seen some indications that we are seeing Schneider a little bit softer. There you go. Nestlé's kind of fairly flat. The defensives are doing OK. LVMH still up today, actually, which is interesting, as is ASML. Novo Nordisk up by 1.1%. Individual stock stories. Joe, what do you got?
So we are seeing some weakness now in SAP in the open of trading over in Germany. That was actually the worst performing stock on the Stock 600 today, declining 4% on news that the US is looking at potential price fixing enterprise software sold to the military, other departments in the US. Now SAP declining to comment on this when we reach them, but we are seeing weakness in that stock, pretty significant, down 4% at the moment. Then we're going to go over to the best performer today. It's not an area we look at too much. It is a Finnish paper company, Valmet, getting a €1 billion order from Brazil. That broke last night, so that's the best stock we've got today. Valmet soaring over in Helsinki, not a place we go too often in terms of both sectors and the exchanges. But here's the deals in focus now. RightMove coming down. I've just been reading Panmure Liberum's note on my phone just a moment ago, and they say they see a very low probability of this takeover going ahead, partly because it is cash and stocks, and they say a lot of UK funds will not want to hold shares in the enlarged company, so they think that's a big stumbling block there. We had Sanofi earlier reporting from Bloomberg's deals team reporting potentially that they're going to get a couple of separate bids from private equity. They may have actually received the bids and they're mulling them over for their consumer health business, a couple of $1 billion that unit's worth, but that stock heading lower. And then the London Stock Exchange looking to offload 5% of a stake in Euroclear, one of the big clearing houses in Europe. They own a stake in that. They're looking to sell that. That's according to a Sky News report. But LSEG shares holding it pretty steady at the moment. Then there's a couple of sectors to bring you. Payment processors. Now, global payments in the US plunged last night following weak results, weak volumes out of them. And we're seeing a little bit of weakness today coming into Adyen, also Nexi over in Italy, Worldline in Paris, all of those shares coming down. That is a read across from the US. The other sector I wanted to look at was miners. You did mention earlier, we're seeing gains yet again, given we saw massive jumps yesterday, pretty impressive on that China stimulus news. All of these stocks were up around 5% or more. Just noting Rio Tinto also had a presentation to investors today. That was over in the US. That was a US business. They published that this morning, according to analysts. Take a look at Air France now. This is the biggest gain since December for this stock. JP Morgan double upgrading, underweight to overweight. They like the pricing in the sector and they like the fact that fuel prices are coming down and everyone booking holidays. I've just booked some summer sun over in December as well. I'm looking forward to that. But holidays are a good space, according to JP. And finally, one getting a negative analyst rating is AXA, downgraded at CIC in France. Now, they say that this is a valuation call. The wealth business, insurance business, doing really well at AXA, but the stock's rallied so hard, they think you should be no longer buying, and they downgrade to neutral. AXA falling 2% in Paris this morning.
Joe, thank you very much. Joe Easton from our equities team with an update on some of those movers and his holiday plans. Nice reminder. I'll get on it. Get booking. Let's have a look at what we're hearing from Andrea Orcel, the UniCredit CEO. He's speaking at a conference, a Bank of America conference on the banking sector, and he is saying some interesting things about Commerzbank, describing it as a strategic fit for UniCredit's metrics. We'll get more on that in a moment. Oliver Crook joins us with a breakdown. This is Bloomberg. Welcome back to the opening trade, 8:21 in London, 9:21 if you're in Frankfurt or Berlin, and watching this with a view to what happens to Commerzbank. European stocks then under pressure a little this morning after the gains of yesterday. We're getting new lines coming out from Andrea Orcel, the CEO of UniCredit, about Commerzbank, speaking at a Bank of America banking conference and saying that Commerzbank is an investment for us, nothing else. Then going on to say it is a test case for Europe. Let us bring into the conversation Oliver Crook, who's been following the story for us, of course, from Berlin. Ollie, good morning. So, I mean, how do we interpret these lines from Orcel? On the one hand, saying this is just an investment. We might do it, we might increase or we might sell the stake, suggesting he's not very attached to it. But at the same time, describing it as a test case for Europe, that, he knows the stakes here are pretty high.
Yeah, and it's pretty interesting. I think Andrea Orcel playing it pretty cool here, as he has from the beginning, saying that he's intensely patient, that they could go up, they could go down. They're just going to see how this thing sort of materializes, while at the same time raising his stake to almost, more than a fifth of the holding of the bank. What I find interesting about these lines, Anna, is that we have been hearing a lot about what the government has had to say, what the unions have had to say. We have heard very little about what Commerzbank shareholders have to say, whether or not they are in favor of this deal. And when you look at Andrea Orcel, and in terms of how shareholders are going to look at him as a potential owner for this bank, he has done very well on profitability at UniCredit. He's done very well on payouts. And in these lines, he's reiterating how much money UniCredit is distributing to shareholders, saying that they're going to put out, that they're going to reach profit of 10 billion euros, that they're going to pay out dividend, move to 50% from 40%. If you're a shareholder in UniCredit and you're listening to this, is this Andrea Orcel making a case for you in order to try to go in this? Not only that, he's also making the case that this is about broader Europe and making banks competitive within Europe. He's really trying to make himself the sort of best case for shareholders, but also for banking in Europe. I think these lines are very interesting in terms of who he's trying to speak to.
Yeah. Be interesting to see if the ECB can block this, could block this, should block this. Will Germany block it? Let's talk about that just in a moment. I want to come back to that idea. But let's talk about Bettina Orlopp. Does she have a better plan for Commerzbank than Andrea Orcel? That's the key question here, isn't it?
Yeah, I think it is part of the key question. It's a case that they're going to have to make to shareholders. And it's a case that, by the way, they're making to shareholders right now, literally as we speak. The management committee is in front of the supervisory board. They had their first day of meetings yesterday, from which we got this decision to put Bettina Orlopp as CEO to replace the outgoing CEO. The outgoing CEO, who, by the way, said that he did not want to have his contract renewed the day before all of this happened. So for the management perspective, before they have any sort of ideas on strategy, they need someone strong and that's committed to the bank to be leading the bank, and that's what they get in the form of Bettina Orlopp, who's been there since 2014 and CFO since 2020.
And thinking about who decides and who gets a say, who gets a seat at the table, you've referenced shareholders broadly, Ollie. Of course, that includes the German government. But we heard from Christian Lindner yesterday in the German government, and he said this decision is up to the management and the supervisory boards, and they do want to continue eventually selling down that government stake.
Yeah, absolutely. And I think that's why it's really interesting to hear from the finance ministry and the FDP, the liberals, who are very economically more on the sort of libertarian side. They do not like government involvement in companies. They think that they should continue to sell the shares. They were uncomfortable about the way that the approach went by, which is why they have now stopped selling the shares. What I think is interesting is thinking about how do the German government actually interfere with this and block the sale if they want to. What means do they have? I mean, I think that the best way for them to do it is probably just to hold on to 12% of this stake in the bank and be just a very difficult party when a company is trying to be taking over. If someone who owns 12% of it wants to block it, of course the unions are trying to take a different tack, saying that they should declare Commerzbank a critical infrastructure, which would be a sort of another way of going about it. But there are a lot of different paths that they'll have to be evaluating.
How European does Germany feel right now? So there's a big push to get cross-border banking deals over the line. Let's see how Germany reacts to that. There's a big idea that Europe needs to become more competitive, that we need to see common debt. You've got, obviously, Draghi talking about that. Germany doesn't feel particularly minded to do that as well. How European is Germany?
I mean, that is precisely the point that the foreign minister of Italy made yesterday, saying that basically when companies want to come into Italy and buy a company, no big deal. It's a free market. It's an open market. But when Italy suddenly wants to go into Germany, suddenly it's not a free market. Again, Guy, we talk at the sort of essence of what is Europe going forward? How is it going to remain competitive? We talk about a banking union. By the way, we've spoken to the German finance ministry who said, how brave do we want to be? Do we want to let companies move across borders and do these sorts of things? But maybe there's a little bit of not in my backyard. When it comes to Germany, these issues become much more politically sensitive, particularly, Guy, at a time when you have these sort of rising nationalist forces within Germany.
Ollie, great stuff. Thank you very much indeed. You also got the Volkswagen story today. Keep an eye on that. You got the SAP story. Keep an eye on that as well. Busy day in Germany. So let's talk about what we're going to talk about next. 25 or 50? No, I'm not talking about the Fed. I'm talking about the Riksbank. Will Sweden go for a big cut that it potentially discussed last time around? The economists don't think so. They think 25. We are about to find out. We will bring you that Riksbank decision very, very shortly. 25 or 50? This is Bloomberg. $50 or 25? The answer is 25. The Riksbank has just cut rates from 3.5 to 3.25. They discussed last time around that we potentially could see a 50 basis point cut. It was discussed. That has not turned out to be the case. So the Riksbank has cut rates by 25 basis points. The expectation is that we are going to see a series of 25 basis point cuts coming through. The currency has improved recently, which takes some of the pressure off as well. The Riksbank now sees CPIF, which I'm assuming is some sort of variance of CPI. I'm not sure what the F is, but we'll come back to that, at 1.6% in 2025 versus 1.8% previously. So they're downgrading expectations. Riksbank may also be cutting the 2 remaining meetings this year. Now sees GDP at 0.8 in 24 versus previously 1.1. So they're degrading inflation and growth.
Yes, and that seems to be moving. You're looking at the Swedish krona against the euro. Do you see to be a little bit of movement on that? Maybe that line that they may cut at the 2 remaining meetings this year. That is a fast pace for Europe, as we were discussing with the guest earlier on. That's a fast pace of cuts coming through. But that's the story in Sweden, and that moves the euro, as you can see. Let us pivot our conversation to rates over in the United States. Joe Biden has predicted that the Fed will cut rates further. The US president was speaking at the Bloomberg Global Business Forum, where he cast climate change as a new economic opportunity for America.
In fact, it's a perfect time to go big. The market for clean energy is booming. Inflation is way down in America. The Federal Reserve just announced lowering interest rate, and I predict they'll go further down. We should give business even more confidence to invest trillions of dollars that are on the sidelines in the clean energy industries of the future.
President Biden there speaking at the Bloomberg Global Business Forum, talking about his expectations for rates. We'll see what the Fed decides to do. One part of the market that might not benefit from lower rates could be private credit. The asset class, at least, more than doubled in size since 2019, thanks to interest rate hikes that made its floating rate debt more attractive to investors. So as rates come down, how nervous is the sector? Let's speak now to Eric Hirsch, co-CEO of Hamilton Lane Advisors, with us on set here in London. Really good, Eric, to have you with us. So I suppose I just want to get your big picture expectations then about rates coming down and what that does to appetite for private assets, such as private credit.
Yeah, I think there's a few factors here, and good morning and happy to be here. I think President Biden certainly wants rates to be coming down and coming down fast, ideally before the election. That's not going to happen further. And so I think, what do you see for private credit? I don't think the driver of private credit has actually been rate hikes. I think it's really been banking dislocation. I think if you look particularly where the growth has exploded, and it's been mostly in the U.S., although Europe has been a big beneficiary of this as well, you really have seen kind of the collapse of sort of the regional banking sector. And those were typically the providers of loans to private businesses. And now sort of the private credit industry has kind of stepped into that void. So I think rates, whether they're higher or lower, I don't see that sort of sapping the appetite for that sector.
So you see that's resilient. So even if we get cuts continuing over, months and all the way through 2025, what is your expectation then for the appetite that investors will have for private credit in that environment?
I think the appetite for investors, I think, will remain the same, because in a lower rate environment, it's a relative play. So whether private credit is coming down because rates are down, so too is public credit. And one of the reasons why we've seen the rotation is because the gap between sort of private credit returns and public credit returns have sort of favored the private side. And so that disparity will still be there, and I think you'll still continue to see that rotation.
There's too much money gone into private credit.
Yes.
There's a lot of... Yeah, OK, fair enough. So what does that mean?
So I think there's a piece here of too much money means there's too many players today, perhaps too much inexperience. And so I don't think we want to paint with a broad brush and say all private credit is terrific and everyone.
When do we see the divergence between the well-managed funds and the not-so-well-managed funds?
We start to see that when the economy softens a little bit.
When does that happen?
I think we're not going to see that for a little while. I think the market remains very resilient. And so one of the reasons why you're seeing kind of that dispersion of return in the private credit sector not widen out is that we're not seeing defaults. We're not seeing bankruptcies.
When do the defaults come? Because there's inklings that's starting to pick up a little bit.
Perhaps. I think we're going to need to see, again, real economic downturn before we start to see that. For all the talk of private credit people saying, oh, we're happy to own the asset, they don't want to own the asset. So right now, people can refinance and change and alter fixed terms, and they're doing that. That's not a bad thing for the economy. We don't want to see, defaults are not good for anyone. And so right now, as long as you see a huge supply of capital in that market, you're going to see flexibility. Flexibility is not a bad thing, and people are taking advantage of that.
And thinking about the regulation, you mentioned that one of the drivers of interest in private credit has been maybe a mess in the banking sector and private credit stepping in. And I'm sure, to some degree, plenty of voices in sort of regulatory circles will be pleased that we didn't see a big pullback in lending in the economy as a result of the problems at SVB and the like. But then the spotlight turns, and then people start to ask, well, how much transparency do we have? Is this a sort of shadow banking risks that we're building up here in private credit? What have we learned on that front, do you think, in the last sort of year or so?
I think as the private credit sector continues to grow, it's already regulated and it will become more regulated. There's no question that there will be increasing calls for transparency. That will happen. I think everyone's sort of expecting that to be the case. again, the firms that are sort of the dominant players in that lending space, they're big firms. They're, in many cases, they're global firms. They're, in many cases, household names. And so they're already under a lot of regulatory scrutiny. That's not going to abate. That will, in fact, just do nothing but increase.
Does it dent the investment case, though?
It doesn't. I think the investors are fine with more of that, and frankly, so too are the service providers. This is sort of the cost of doing business.
Is private equity going to struggle to raise money if it doesn't give some money back?
Yes. Yeah, I think there's no... You see it already.
Yep.
You see
when
it
do
today.
exits happen?
So we're seeing...
There's a little bit, but there's not enough.
There's not enough given the amount of dollars that they're investing.
Yes.
The sector needs to remind itself that we need to keep things in somewhat of balance. We can't just simply have deals, and no sales. We need to have both. And right now, you see a real imbalance of a lot more capital is going out to do new transactions than is coming back from exits. And investors are simply a little bit cash-strung. You couple that with just an enormous amount of products in the market. We've never actually seen more product in market than we are today, period. And so that is an overwhelming amount of choice. Choice can be good, but choice can be also overwhelming.
Why should I invest in private equity when IRRs are sub 10? The equity market, the public markets are doing much better. Public credit's doing okay. 10%, less than 10% isn't enough.
I think if we're only looking at it on a one-year basis, then you're absolutely right. But once we stretch that view out to a 3, a 5, a 10, a 15,
so
or a 20...
IRRs are going to go higher, are they?
Well, historically, they've been substantially higher. The outperformance against the public market...
Was that an anomaly, or was that... Is this the normal?
Can't be an anomaly when you have it on a 5, 10, 15, 20, 25. And so I do think that this is a moment in time. The public markets have been incredibly strong. However, as you all often talk about, driven by a very small number of companies, and they all have one thing in common. There's a massive play right now globally on AI. And to the extent that that doesn't sort of come to fruition as people are already pricing into the market, we're going to see a significant public equity market pullback. And I think that, to me, is sort of the head of the pin that we're dancing on right now.
And what's the read across into your world if we do see that?
Well, we don't cheer for public market decline, but we don't love when public markets are skyrocketing because it leads to this issue of 10% may not be attractive enough on a relative basis. And so incredibly frothy public markets is never the friend of the private side. We'd like to see things a little bit more sane, a little bit more normalized. And I think that's what's coming.
I was going to ask you if that's what brings you to Europe, and I'm not sure if sane and is that sane, normalised? Is that why you're here? I mean, valuations don't maybe look as frothy as they do in the States. I mean, what's the attitude towards European assets?
Well, I think it's a great question. And so there's a real difference between the public markets. You see sort of a real valuation disparity. In the private markets, not so much. So the typical private equity deal in Europe is being done at about 4 or 5% less than the U.S. So not a huge differential in the private side.
And exits here? Is it easier? What's going on?
I would say it's similar. You're not seeing massive exit activity here. You're seeing a little bit higher than in the U.S. And so, but we have the same imbalance here as we do kind of around the rest of the world.
Does taxation start to change the story in Europe as well? We're starting to see a pushback against private equity and higher taxation in places like France being talked about by the government as well.
I always say this is an asset class where people have gotten very wealthy. They're going to continue to stay in this asset class, even if tax rates go up a little bit.
Okay.
Eric, thank you very much.
Pleasure.
Thank you for joining us. Eric Hirsch, co-CEO of Hamilton Lane Advisors. Really interesting conversation. Thank you very much for joining us around the table. Shall we go to Riksbank or UniCredit?
I want to talk about the Riksbank for just a moment.
OK, let's go
because
Riksbank.
We had the 25-50 debate, which is obviously something that we've kind of gone through in the United States, but we're now having it firmly in Sweden as well.
Yes.
So the Riksbank's just cut by 25 basis points. You can see the reaction in the market. The euro's up quite strongly. But the Riksbank is pointing to the fact that it sees more rate cuts coming through potentially this year, and it will not take off the table the possibility that we see a 50 basis point cut coming through. So the 25-50 debate is very live in Sweden at the moment.
Yes, and live in Europe then, it's at least somewhere, in some geography. I was reading Marcus Ashworth in one of his opinion pieces talking about, liking some of the messaging at least. I think he was quoting Goolsby on the Fed and suggesting that was clearer guidance about the extent of the rate cuts we're going to get stateside and wanting to see more of that in Europe. Maybe he's happy with the Riksbank this morning.
Well, they've only delivered 25.
No, but the language.
The language is certainly more dovish and hinting at more dovishness. So we've got 2 more remaining meetings so far this year, and there's the possibility that one of those at least could be a 25 cut. So it was the pricing up until now has been 25, 25, 25. but maybe actually rather than the 75 in totality, you get 100. And that maybe is what is moving the euro-dollar at the moment.
Shall we pivot to what is being said? A lot is being said by Andrea Orcel right now.
He's got a lot to say.
About Commerzbank. He's being asked a lot about this at a Bank of America banking conference. He's the red headline that's caught the attention of our editors this morning. UniCredit is not going to ask for a board seat at Commerzbank, and there's a load of other lines coming out here. We talked earlier with Ollie about the fact they're saying that this is a test. He's saying this is a test case for Europe, but at the same time saying that this is just an investment. It's nothing else.
Does he not want to ask for a board seat because he wouldn't get one? Would he be rebuffed by Bettina Orlopp? Is that kind of the suggestion there? What would Jens Weidmann make of that approach?
Does that make it easier for the German government to approve to the extent that they get a say as shareholders? But we've heard from Christian Lindner, they do plan to sell down that stake that they still have there.
What do you do? You're a shareholder. Who do you think is going to be the best custodian of this asset? Is it going to be Bettina Orlopp? Or is it going to be Andrea Orcel? He has done very well at UniCredit. You look at the metrics that are coming out of that bank, you look at the valuation it now trades on. Do we believe, as investors, hypothetically, that he is going to be able to run this asset? And how difficult is it, therefore, to resist?
Yeah, you want to weigh these up on a sort of all other things being equal basis as well, don't you? And we're dealing with the German economy right now, where a lot of moving parts exist.
Sure.
And, so I just wonder how much complexity that's going to add in. Like Andrea Orcel's talking about the Mittelstand, that's one of the things that draws them to Commerzbank. And every time we speak to Bettina Orlopp, we talk to her about how the Mittelstand is doing. And it's been fairly resilient up against some of the other headwinds, and there are plenty that big business in Germany.
But that's where the concern lies, is that relationship. What happens to Germany? What happens to Germany AG if you see this being taken out of German hands? How does that lending continue? And what happens, therefore, to the German economy? But Orlopp's in a really difficult place as well. If she wins, i.e. she keeps it as an independent entity, does the share price remain where it is right now? Or is the first thing that's going to happen as she takes over as CEO is that the share price drops dramatically?
Yes, I wonder what success looks like for her.
Potentially a lower share price.
This new job she's taken on.
Yeah, a lower share price, from her point of view, may signal success. And therefore, she believes that she, on a longer-term trajectory, can take it higher.
And this is not the only German story we're dealing with this morning. Shall we talk a little bit about SAP?
It is, the stock, last time I checked, the stock was down. We'll talk about it a little bit more. It's gearing up for a fight. US officials investigating SAP for price fixing on various government agencies, including military contracts. We'll talk about what that means for the stock next. It has had a great run. It is the highest cap stock in Germany right now. We're going to talk more about SAP next. This is Bloomberg.
Welcome back to the opening trade. We are 46 minutes into our European trading session, and we have a little bit of weakness coming through in some European markets. The DAX and the CAC 40, you can see, under a little bit of pressure this morning. Let's pivot the conversation, though. At Climate Week in New York, the Earthshot Prize Innovation Summit, organised by Bloomberg Philanthropies, concentrated on enhancing climate solutions. Ruth Porat, the president and CIO of Alphabet, spoke to Bloomberg's Eric Schatzker about the balancing act of AI.
This is an opportunity, a legacy opportunity for economic growth in delivering these benefits to everyone in this country. And that starts with infrastructure, the investments that you were asking about, deep technical infrastructure, the subsea cables that link everybody up. But it then very much goes to you have to be connected to access the information and tools that ensure that everyone, everywhere around the planet, has the same quality of information and access to markets that everyone in this room has. And one of the things to your question about AI is we are now serving people around the globe in 246 languages. But what's really profound and goes to this notion that AI is moving really quickly, we added 110 languages in the last 6 months alone, which means 500 million people on the planet can now access information in their own language. That's the second part of the triangle. The third part of the triangle is ensuring that people have the skills to thrive in this changing world and ensuring that we're doing the right kind of training, skilling globally. Delivering on that triangle maximizes the upside and helps with some of those issues that you asked about on the downside.
President Biden will be here on this stage in a few short minutes. Please don't think of us as the warm-up act. His administration has developed a wide range of initiatives around AI. What do you hope to see in terms of AI policies from the next president, whomever that happens to be, and the next Congress?
Well, I think very importantly, let's take stock of what has been done, because I think at the core of the approach from the White House, from the president and his team, has been a recognition about the strategic imperative due to the economic upside and the social benefit upside. And so it's about maximizing the upside, mitigating the downside, and bringing together experts from the private sector and the public sector to work together has been key, point number one. Point number two, they've taken a risk-based approach, which is a recognition that AI is applied to many different things in our daily life. The opportunity is wide, and so there's not one size fits all. Think about the risk inherent in the application of AI in any area. And then they've required the industry to do a number of things to actually mitigate against the downside around transparency, around red teaming, things to prevent abuse of it. The other thing is really encouraging bipartisan solutions. So I would also say, if I could broaden it out, right now in the Senate, there's a bipartisan approach around an AI framework that Senator Schumer and Brown and others have proposed. And again, it looks at all elements of how do we invest to be competitive, how do we prevent working on the downside. So I would hope it's a continuation of this and that it continues to be bipartisan because it's such a critical issue.
Ruth Porat there, the president and CIO of Alphabet, speaking to Bloomberg. Really interesting then, the AI threads this morning in our conversations, talking there about the energy needs and the opportunities, but also with Eric Hirsch talking about the sort of opportunity cost if money goes into, if money keeps going into AI and the AI boom, then what does that do to other assets that also want to get a piece of that?
Starve them potentially of capital. But do you see a spreading out of that AI boom into other spaces? And I don't mean just buying other things. I mean, does the effect of the AI story widen out? Do we see, and you're seeing it already, like grid operators doing very well, the companies that provide nuclear power, for instance, starting to benefit as the tech companies look to how they're going to power their server farms. It does feel as if there's the sort of the second, third derivatives of this story beginning to be put into place.
One that hangs over so many other themes that we talk about. Let's stick with the tech theme, shall we? US officials are investigating German software giant SAP for potentially conspiring with other firms to overcharge government agencies over the past decade. Let's get the story with Bloomberg's Karen Matusek, who's with us this morning. How did all this come to light then, Karen? Because one thing that comes out as you read the story this morning is that this is an investigation that has perhaps been running for quite a long time.
Yeah, it came out more or less by accident, actually. My colleague Jake in the US, he spotted some filing in US court docket in a litigation between Carahsoft, the big reseller of software to government, and the government, who wanted a document from Carahsoft, and they apparently didn't comply fully, or at least in the view of the government, didn't comply fully with the order, and then litigation started in court, and in that litigation, this probe was mentioned, and SAP was also mentioned.
What do we know about where the investigation stands?
We don't really know how long this has been going on. That's kind of one of the big questions, and how big the volume of contracts that are touched are. But we do know that in 2 years ago, in about June 2022, this struggle between Carahsoft and the government over handing over documents started. That's when the order came out, and that's when the litigation started. So that's so far what we know. What we also know is that on Tuesday there was a big raid of Carahsoft, and we don't really know it was related to this probe, but Carahsoft said it was related to an investigation into a company which with Carahsoft was doing a business. So it's that's what we know at the moment.
Yeah, and the SAP share price then down 3.8% this morning. What are the risks for the business?
Well, you know, being in trouble with the US authority isn't exactly fun. They aren't shy of imposing hefty fines. A lot of German companies have experienced that. So I'm sure investors are a bit concerned about that. In these kind of price-fixing probes, the government, under the US laws, can impose kind of a triple of their damage. They can recover it, plus some additional fines. It depends. I mean, this is probably, it depends on who is going to get those fines, and it's still, we don't know what will come out of the probe. Many probes don't end with a formal imposition of something like that. But you know, at the moment we talk about risk, and these are the risks that they are facing, actually.
Can I just talk about what is happening with the German economy, what's happening with the DAX, which is doing very well right now, and the corporate stories that we're focusing on a kind of bottom-up kind of a basis. So you've got SAP, which has been a star performer this year. As you say, now there's a little bit of a black spot against it, potentially in the form of this. We've got VW. So Volkswagen today is starting to talk with its unions. We don't know how that's going to go. We've got the Commerzbank story unravelling as well. We don't know how that's going to work out. How does the corporate story in aggregate feed into the kind of the national macro story in Germany right now? Can I relate what is happening with the macro data, the DAX performance, and the single stock story together? What is the picture coming out of Germany in totality?
Yeah, I think Germans are really in a bad mood at the moment. Despite as you said, the good performance of the DAX, you have these big kind of light companies that stand for what Germany is proud of its economy, in its economy, especially VW, but also SAP. SAP is one of the big tech players Germany or Europe as a whole has, as compared to the US. So it's kind of getting people in a bad mood and looking. And Germans are particularly good at saying, oh, everything's bad, oh, things are turning bad. We are really on a bad track, and At the moment, a lot of stuff is hitting the fan here, and people are really kind of worrisome. And this is kind of, we have VW, we have Commerzbank, now SAP on top. It's like every morning you wake up and say, what's going on now? So it's troublesome, especially for the government, which is kind of in a kind of bad position anyway. And now they are also having one trouble after the other on the corporate side. It's really not fun.
It's not fun in Germany right now. Karen Masisek, thank you very much indeed. They just had the World Cup. They've just had the Euros. The football was great. We all enjoyed that. It's been a great summer. It's a bit like France as well. Had the Olympics. Things are rolling over a little bit.
Yeah, a bit like it's just the morning after, isn't it?
A bit like that, yeah.
All of that fun sport. Just a little bit more insight into the lines we brought you earlier about Orcel saying we won't seek a Commerzbank board seat. He goes into some detail. He's been speaking this morning at this Bank of America conference saying, in this specific case, I think it's inappropriate for us to have a board seat because we're also a competitor. I don't think that's correct. So that sounds temporary, doesn't it? Because he's describing himself as a competitor right now. That's with HVB. So they don't think it's appropriate to have a board seat. But if they, that doesn't mean that that's the...
Might have all the board seats soon.
Yes, exactly, at some point, if the story develops in a certain direction. But it's too soon for that.
He's definitely hedging his bets, isn't he? But he has the ability to be able to do that at this point. This could just be a great investment. It could work out really nicely. It could be a great trade. Maybe that's all this is at this point in time.
Yes, absolutely. There are a lot of derivatives involved in getting to that 21%, and that's maybe where the story will be. Deutsche Bank CFO also commenting, saying they're focusing on themselves. A lot of news flow then coming from this Bank of America banking conference this morning. That is it for this hour of programming. We'll leave you with The Pulse. This is Bloomberg.